Want to be a smarter investor? Let's talk about investing. You work hard for your money. You want to see it grow. That's where the Sharpe Ratio comes in. It's a tool that can help you make smarter investment decisions. Think of it like this. You wouldn't buy a car without checking its gas mileage, right? The Sharpe Ratio is like gas mileage for your investments. It tells you how much return you get for the risk you take. We'll break down the Sharpe Ratio. We'll use simple terms. No jargon here. We'll also show you how to use it to make your money work harder for you. So, buckle up and get ready to become a more informed investor. The Sharpe Ratio is a way to measure the performance of an investment. It considers both the return and the risk. A higher Sharpe Ratio means you're getting more bang for your buck. You're getting more return for the risk you're taking. A lower Sharpe Ratio means you're taking on more risk for a smaller potential return. Not ideal. It's important to remember that every investment has some risk, but some are riskier than others. The Sharpe Ratio helps you compare different investments. You can see which ones offer the best balance of risk and return. Okay, so how do you calculate this magical ratio? Don't worry, it's not rocket science. First, find the average return of the investment. This is the amount of money you made or lost. Next, find the risk-free rate of return. This is the return you could get from a very safe investment. Think government bonds. Then, subtract the risk-free rate of return from the investment's average return. This gives you the excess return. Finally, divide the excess return by the standard deviation of the investment's returns. This measures how much the returns have fluctuated. Congratulations! You just calculated the Sharpe Ratio. Understanding Sharpe Ratio values. Now, let's talk about what the numbers mean. A Sharpe Ratio of 1 or higher is generally considered good. It means you're getting a decent return for the risk you're taking. A Sharpe Ratio of 2 or higher is excellent. This is like finding a golden ticket. A Sharpe Ratio below 1 is not so good. It might be time to rethink that investment. Let's say you're looking at two investments. Investment A has a Sharpe Ratio of 1.5. Investment B has a Sharpe Ratio of 0.8. Even if investment B has a slightly higher return, investment A is probably the better choice. Why? Because it has a higher Sharpe Ratio. You're getting more return for the risk you're taking. Limitations of the Sharpe Ratio. The Sharpe Ratio is a helpful tool, but it's not perfect. It has some limitations. First, it assumes that investment returns follow a normal distribution. This isn't always the case. Second, it doesn't account for all types of risk. For example, it doesn't consider tail risk. This is the risk of a rare event that could cause a big loss. So, while the Sharpe Ratio is a great starting point, it's important to do your research. Don't rely on it alone.